For decades, investors and academics, pretty much everyone, has been chasing this kind of holy grail, a single, perfect formula for building an investment portfolio.
So, is there some magic formula out there? It sounds simple, right? But believe me, the answer is, well, it's anything but. This is a journey that's going to take us from a Nobel Prize-winning idea all the way to the messy, chaotic reality of the financial markets. So yeah, let's unpack this thing.
All right, so our story kicks off with this just beautiful, almost irresistibly elegant idea. We got to go back to the 1950s when an economist named Harry Markowitz came up with something we now call modern portfolio theory.
And at the heart of it all is this concept called mean-variance optimization, or MVO for short. Think of it as the mathematical engine driving Markowitz's whole theory. The big goal here? To find what's called the efficient frontier, which is really just a fancy way of saying that perfect sweet spot, The place where you're squeezing out the absolute most return for whatever level of risk you're comfortable with.
And look, on paper, it's perfect. It basically suggests that if you have the right math, you can literally engineer an optimal portfolio. No more guesswork, just pure, clean optimization. I mean, what's not to love? It's an incredibly appealing promise. But, and this is a big but, this is exactly where our story takes a very sharp turn.
So, despite its fancy Nobel-winning pedigree, MVO often fails in the real world. And I don't mean it's just a little off. I mean it fails spectacularly. This wasn't some minor glitch. It was a huge, fundamental problem that had people scratching their heads for years. So what gives? Why would such a perfect-sounding theory just break so badly?
The key, the absolute smoking gun, is right here in this quote. Back in 1989, Richard Michaud famously called MVO not an optimizer, but an error maximizer. What did he mean by that? He basically argued that instead of finding the best portfolio, the model has this really nasty habit of finding the one that's most sensitive to tiny, unavoidable errors in our data. Let me show you exactly what that looks like in practice. Okay, so let's imagine we feed all our historical data into the MVO machine. And boom, out pops this beautiful, perfectly diversified portfolio. Everything looks fantastic, right? We've got a really sensible mix of assets, and we're feeling pretty good about ourselves.
But here's the thing. Our historical data is never perfect, and our guesses about the future, they're always going to have some errors. So let's just introduce a tiny, almost unnoticeable error. We're just going to tweak one single expected return number by just 1%. That's it. What could go wrong?
And bam! Just like that, our once perfect portfolio is completely wrecked. It's totally transformed. Now it's super concentrated in just a couple of assets, and it makes absolutely zero intuitive sense. That tiny 1% input error, it created this massive nonsensical output. That is the error maximizer in action.
So what on earth is going on here? Is the math just wrong? Well, not exactly. The problem isn't really the optimization formula itself. The real culprit is the data we're feeding into it. Turns out, real-world financial data just doesn't play by the rules. It doesn't behave the way our clean, perfect theoretical models think it should. You see, in a textbook, everything follows this nice, neat, predictable bell curve, right? Where crazy extreme events are super rare. But market reality? Oh man, it's chaotic. It's wild. Those massive crashes and insane rallies, they happen way more often than the theory would have you believe. And this whole phenomenon actually has a name. They call it heavy tails. All that really means is that the tails of the distribution, the parts that represent those extreme highs and lows, are much thicker or heavier than they would be in a perfect bell curve. These are those black swan events you hear about, and our simple models just can't handle them.
And it gets weirder. There's another quirk called volatility clustering. Basically, trouble doesn't just spread itself out evenly over time. Nope. Instead, you get these calm periods, and then bam, you get a period of intense chaos. High volatility likes to hang out with other high volatility, and low volatility sticks together too. And this clustering just completely shatters the assumptions of our simple models.
So, with all these problems, did everyone just throw in the towel? Not at all. Actually, the entire field just shifted its focus. The goal isn't about chasing some fragile, perfect portfolio anymore. The new game is all about building a robust one, something that can actually withstand the messy reality of the markets.
And a modern toolkit for doing this really has three main pillars. First up, use better estimators. We now have statistical tools that are actually built to handle messy stuff like heavy tails, which gives us a much more realistic starting point. Step 2, employ robust optimization. This means we design portfolios that are meant to be stable even when we know our inputs are a little bit off. We're basically planning for our own mistakes from the get-go. And third, and this is a huge one, we have to be brutally honest with ourselves about how we test our ideas.
Which brings us to what some people call the 7 sins of quantitative investing. There are a few common traps, like survivorship bias. That's when you only test your idea on companies that survived, completely ignoring all the ones that went bankrupt. It makes the past look way rosier than it was. Then there's overfitting, or data snooping. It's like torturing the data until it confesses to anything. You create a model that perfectly explains the past, but is totally useless for the future. And of course, storytelling bias. That's our very human need to create a compelling story to explain what was probably just a random blip in the data.
Okay, so let's bring this all home. After this whole journey from a perfect theory to a super messy reality, what's the big takeaway? At the end of the day, it's a fundamental shift in how we even think about the problem. And this really is the single most important point. We've stopped chasing some mathematically perfect portfolio because we now know that's a fragile, brittle goal. The real objective today is to build a portfolio that is robust, one that's resilient to errors, one that accepts the wild nature of financial markets, and one that's designed to do reasonably well across a whole range of possible futures, not just one perfect version of the past.
And all of this leaves us with a really fascinating question to think about. In a world with incredibly powerful algorithms and just mountains of messy data, what's the real value of human judgment? As our computers get smarter and faster, the challenge isn't just about crunching the numbers anymore. It's about having the wisdom and maybe the humility to understand the limits of our own models. Maybe the perfect portfolio was never about finding a formula in the first place.